Hello everyone and welcome to Tax Shorts. My name is Ayesha Bedwei. I'm the tax leader here at PwC in Ghana, and today I'm joined by my colleague Laura Torgbenoo Fiagome, who is a senior manager in our indirect tax business. And today we'll be discussing taxing the digital economy. So Laura, when I think about the digital economy, I just think about the way things have progressed and how taxation has struggled to keep up. And in the last decade or so, things have really changed and the number of digital transactions have been on the increase. What do you think about that when it comes to taxation? Have our laws kept up or not?
Okay, so when I think about this, it takes me back to the fact that countries globally really have gotten used to taxing the traditional businesses. So if it's a brick and mortar business, we've pretty much figured out what to do. But the digital economy is a whole different ballgame. For instance, when goods come in through a traditional port of entry, it's relatively easy to impose customs duties and associated taxes and levies. But what happens when it comes to the digital economy? What happens with intangibles? What happens with electronic transactions, or even corporate taxes, for instance? How do you tax a company that you know is providing consumer services in your country but doesn't have a fiscal presence in that country? So these are really some of the challenges that the digital economy presents that our laws are trying to keep up with.
I think we can all attest to this because I think about the number of transactions that we all undertake online, and I often wonder how the tax authorities in different countries can keep up. I remember back in 2015, the OECD came up with some pillars around BEPS, and Pillar 1 or Action 1 dealt with the digital economy.
It did.
Yeah.
It did. And since then, there's actually been some traction, the pillars like you mentioned. So there's a two-pillar approach that is currently being discussed. Pillar 1 is supposed to provide for a fair distribution of profits and taxing rights across countries. And Pillar 2 is actually aimed at providing a minimum corporate tax rate, so as to protect the tax bases for respective country, but also curb international tax competition to some extent. So, yes.
So I know that various African countries have made progress in this area, but what about Ghana? Have we kept up?
Okay, so the thing with Ghana is we haven't really had an official position on the two-pillar approach, which is not surprising if you think about it, because Ghana was not a participating country in the inclusive framework project. So there's no official position yet, but we haven't remained idle. In 2013, when the new VAT Act was passed to become effective 2014, there was actually a provision in there that made it possible for VAT and associated levies to be imposed on these digital services, e-commerce, telecommunication services that are provided for use in the country by non-resident entities. So while we do not have detailed laws on what happens with the corporate taxation of these entities, at least on the VAT side, we have taken some steps. So the affected entities may actually need to take steps to register and account for VAT and the levies, especially now that the tax authority in Ghana has gone into full implementation mode.
I think what you said is key. It's important that affected entities who are doing business in Ghana through digital means take that step to register themselves, because when they are found out, they may be levied with penalties and interest, which will be very punitive. So I think that's a key point to note. Thank you so much for that insight, Laura.
Thank you, Ayesha. It's been a pleasure.
Thank you too. Thank you so much for joining us today. My name is Ayesha Bedwei. I'm the tax leader here at PwC Ghana. And today I was joined by my colleague, Laura Torgbenoo Fiagome, who's a senior manager in our indirect tax business. See you on the next episode of Tax Shorts. Thank you and God bless.